How to earn 10% returns per year without ETF stocks and index funds. The stock market has been on a bit of a rocky road lately. I'm not sure if you've noticed or not, but depending on when you watch this, so far this year it's not grown much at all, and as a matter of fact, it's probably down for the whole year, erasing the gains that we have gotten over much of 2021. As a matter of fact, if the trend continues, it looks like we may not get a positive year in the markets in 2022 at all. That's to be expected, however. Every year on the stock market is not always up. That said, this got me thinking, is there a way to earn a decent percentage on my money without being tied to stocks? Racking my brain, I discovered, yes, there is. There are a couple ways, actually, and one of them can get you up to 10% per year, depending on, of course, how you choose to execute this investment, and I will be explaining that in this video. So let's dive right in, shall we? But let's start with introductions. You're watching Finance Squared, and I'm Derek West, your host. And on this channel, we love talking about all things personal finance. I think the question that remains is, who might you be? Introduce yourself in the comments down below and let us know if you're looking to make up to 10% returns per year. And while you're at it, like this video for the YouTube algorithm, as it does so much to help us reach more and more folks just like you. Also, don't forget to subscribe so you don't miss out on any of the great videos that come on this channel when they drop. So with a negative stock market so far, is there a way that you can earn a return so that you are not necessarily reliant on the roller coaster of the stock market? Yes, there is. Not all of those ways, however, will yield you 10% per year or even 8% per year. Let's go over just a few of them. But before I get into that, let me just say this. The stock market, particularly the S&P 500, is a proven decades-long winner, delivering actual inflation-adjusted gains of around 8 to 9% annually on average. Some years are gangbusters like 2018, 2019. Others are mixed like 2021. Some are down like 2008. However, over the long run, no other economic engine on earth has come close to those sorts of gains. Maybe a few. We might go over those in a video coming up, so make sure you're subscribed. But what I'm going to discuss in this video is a strategy to help you to diversify, to make sure you get your money into vehicles that have upside in addition to the stock market. So you're just not stuck in one asset class or the other. And when looking to invest, you need to remember that there is risk everywhere. There's no such thing as risk-free investment. One asset class or the other may promise percentage returns of one type or the other, but they all have some risk associated to them. When looking at the stock market, it's that investors may get skittish and sell shares in companies that make up that market, driving those prices of those shares down. In real estate, that risk is that people will lose interest in housing in the area which you occupy, or perhaps, some external force causes the neighborhood in which you have invested in to suddenly become less desirable, forcing your property values lower. So remember, risk is everywhere. And you need to take into account the risk profiles of all the asset classes you're investing into so that you can diversify your portfolio and try and spread that risk out amongst them. With that said, what can you do to earn positive returns this year? Well, actually, there are several awesome ways to do it, with one way in particular allowing you to earn 10% annually, which is one of the best returns of investments that you can expect. Let's take a look at one of the more popular ways to do that, and that is with opening a high-yield online savings account. This is popular for a reason, because when people think about saving and investing, really, oftentimes the first thing that comes to their mind is investing with their bank or saving their money. Banks are traditional institutions and they are thought of as pretty safe, even though they do have their own risks. The greatest of which is inflation, eating away at your savings, while those savings languish in a regular account, which will return you on average 0.06 annual percentage yield. You don't have to live with such low gains, however. You could switch to a high yield savings account, which could give you earnings of about 0.5%, depending on the account, of course. Well, even better rates of return can be found if you put your money into a CD. If you invest in a CD, depending on the term's maturity, of course, you could earn anywhere from 0.5% APY to 1.4% APY. So that same $10,000 investment you made in a high yield savings account could in fact get you $140 per year. Now the plus side with CDs is that they have among the highest rates of return available for federally insured bank accounts. So basically the feds would step in and get your money back to you if the bank fails. The problem with CDs is that your money has to be locked up for a certain period of time, which many could argue is a good thing. Compounding works best when you give it time. So if your money is locked away and you can't spend it, that means that when you can spend it, you'll have much more than if you had spent it already. But if you want to have your financial cake and eat it as well, you can form what is called a CD ladder. Now that's sort of an informal term, but CD ladders are when you invest your money into a certificate of deposit of varying maturity lengths. For example, instead of putting $10,000 into a 1-year CD that you renew every year, you're putting that same money into a 5-year CD that returns higher rates but locks your money up longer. You could divide your money into 5 equal pieces of $2,000 each. Then open a 1-year CD with $2,000, then a 2-year CD with the other $2,000, then a 3-year CD with the other $2,000, and so on. When the first CD matures, you then take that money and put it into a 5-year CD. As each CD matures, you repeat the process. After 5 years, your ladder will have a 5-year CD, and one will mature each year, giving you access to the capital in it with each year. This is sort of a dollar cost averaging approach that is popular with stocks and indices, but this is actuated with fixed income products instead. Now that's a great strategy for safely growing your money over time. The only problem is that the rates of return are still relatively low. Now, they're in the 1.2 to 1.5% range per year, which is much better than what you're getting with normal savings accounts and even some high yield savings accounts. But what if you're looking for higher returns? Well, that's where you step up your risk tolerance and start to invest in bonds. James bonds. That's a goofy joke, I know. I just can't help myself. But if you think about it, James Bond is a superhero-esque style spy who steps up to the plate and assumes the risk of defeating deadly and insane supervillains to protect the free world and gets immense rewards in return. Investing in bonds is kinda similar. Not really. The only similarity here is that investing in bonds can be risky, namely the risk of default. You see, when you invest in a bond, you're basically loaning your money out to some entity, usually a corporation, government, or municipality. To get the best return or yield, you'll want to look for bonds that have the longest term and the highest risk. That higher risk is relative, as bonds are considered to be less risky than stocks in a lot of cases. If you invest in multi-sector bond ETFs, you can expect to get gains over a 3-year period of about 5.41% for the Vanguard Total Bond Market ETF. This bond ETF is a catch-all for bond investors, similar to how S&P bond indices are a catch-all for stock investors. This ETF invests in all taxable, investment-grade bonds that are denominated in US dollars. It will avoid inflation-protected and tax-exempt bonds, giving you the kind of exposure to government, corporate, and other types of bonds to form a well-rounded bond portfolio. There's also the Vanguard Short-Term Inflation-Protected Securities ETF. Now that has a 3-year return of 4.56% around the end of last year. This ETF goal is to help to hedge against the ravages of inflation, which we should be looking to do over the next couple of years. Inflation-protected bonds include a mechanism to increase their interest rate when inflation rises, namely buying U.S. government inflation-protected bonds with terms of 5 years or fewer. Then you have Vanguard Intermediate Term Corporate Bonds. They focus on highly rated corporate bonds which mature anywhere from 5 to 10 years. This lets the fund provide a reasonable level of income while maintaining a reasonable level of risk. With this bond ETF, the 3-year return was 7.44%, again blowing CDs out of the water, and starting to compete with stocks for their average yearly return. There are other bond ETFs out there as well, for investing in everything from municipal bonds to junk bonds, all which come with some pretty good returns but higher levels of default risk. So you can tell that investing in bonds are slightly more risky than putting your money into a CD, but at the same time not as risky as investing in stocks. The downside with investing with bonds is that the interest rate risk is pretty high. Bonds tend to do not so great when interest rates rise. We've been in a pretty low interest rate environment for the last couple of years now, and with that starting to affect the value of the dollar and to increase inflation, many people are speculating that interest rates are going to go up and go up hard soon. That's the sort of thing that no one can really predict, but that also means investing in bonds may not be the best thing to do right about now. Again, that's a judgment call, and that's sort of a risk you're going to have to take. But if you're looking to diversify from that risk, you'll need to step your tolerances up once again. But in return, get some of the best rates of return out there for non-stock financial products. What am I talking about? Well, I'm talking about crypto savings accounts. Crypto savings accounts? Why would you put your crypto into a savings account when it's perfectly fine sitting in your wallet getting more and more valuable? Well, I'm not sure if you noticed or not, sometimes crypto goes down as well. Nevertheless, just like CDs and other high-yield savings accounts, with crypto savings accounts, your money is loaned out to vetted investors and business folks who want to use their crypto to invest it and return a profit for themselves and for you, potentially. If you put your money into US dollar tethered stablecoins, you can earn anywhere from 8% to 12%, depending on the platform that you put your money into. That is definitely on par with what you can reasonably expect out of the stock market. For example, if you deposit your money into Tether, Euro, or US dollar coin loan savings accounts, you can expect a 10.3% rate of return yearly. Not to mention that interest is accrued daily, allowing your assets to grow at a much faster rate than almost any other platform. While investing in more popular cryptocurrencies such as Bitcoin, Ethereum, and others, well, they tend to have lower returns on investment, generally in the 4.5% range, which is comparable with some of the better bond ETFs out there, and much better than what you would be getting if you were putting your money with a legacy high-yield bank account or certificate of deposit. uHolder, Celsius Network, Binance, Gemini, Crypto.com, and many others all have crypto savings accounts with extremely attractive rates that if you're looking for impressive non-stock gains, you should consider. I'll say this again, remember the risk. Each of the investment vehicles I talked about in this video have their own risk associated to them. The lower the risk level, the lower the rate of return, but the higher the assurance that your money will be there at the end of the term plus interest. There is no such thing as a 100% foolproof investment. Be very careful about being lured into investments with the promise of high returns. Oftentimes, those are highlighted and the risks are minimized, but those risks can be very real. As long as you go into your investments with that knowledge in hand, you'll be able to make the right investment decisions with the help of your financial advisor, whom you should show this video to before you make any investment decisions. Because as you know, this is not an investment advice channel. Nope, we're simply out here trying to entertain and inform the general public about all the possibilities and risks that exist out there for the savvy, financially minded individual. If you'd like more videos in that vein, subscribe to this channel and turn on post notifications so you don't miss any of them when they drop. Also, share this with other financially minded individuals like your investment advisor or your other friends who just don't have a clue. Drop a comment down below with your thoughts on making solid gains without stocks. Is there something I'm missing? I'd be delighted to hear your thoughts on the topic. Also, like this video if you liked this video. It helps the channel out so much and I definitely appreciate it. And keep in mind, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take it easy guys, and I'll catch you in the next video.